Welcome back to the Groundfloor Market Trends podcast. This is episode 7, and I'm Patrick Donahue, your host. In this episode, we're going to cover interest rates, builder sentiment, and my favorite ground floor loan, the new construction loan. But first, I want to express some thoughts about Hurricane Helene. The storm has had a devastating impact, particularly for those displaced by its effects to Nashville, North Carolina, and the Eastern Carolinas. At Groundfloor, we understand the long and difficult road to recovery that lies ahead for these communities. We want everyone affected to know that you are not alone in this. As these communities begin to rebuild their homes and lives, we stand in solidarity with them and are committed to supporting efforts that restore hope. Together, we'll move forward towards a brighter days ahead. I wanted to talk today in our housing market discussion about the residential housing market and how remarkably resilient it has been as we enter the final quarter of 2024. Can you believe it? So let's talk about interest rates. We all know in September, the Fed Reserve made a significant move by cutting interest rates by 0.5%, bringing the Fed funds rate down from 5.25% to 4.75%. And we expect an additional 0.25% reduction at the November meeting, and probably another 0.25% reduction at the December meeting. According to the Fed's own projections, rates are expected to drop further, reaching 3.35% in 2025, and by 2026, we're looking at 3.09%. This easing of monetary policy is driven by a cooling inflation rate and the Fed's focus on achieving a soft landing for the economy. Lower rates, of course, impact housing affordability and developer sentiment, which leads me to the next topic: home prices and inventory trends. According to the latest FHFA House Price Index, house prices in the U.S. increased by 4.5% between July 23 and July 24. Similarly, the S&P CoreLogic Case-Shiller Index reports a 4.93% year-over-year increase for July 2024. These are lagging reports, so they're roughly a quarter behind. And what does this tell us? These consistent year-over-year gains indicate a relative balance between housing supply and demand, even though inventory remains below pre-pandemic levels. When we look at inventory levels for 2024, we see that growth has been somewhat flat, but there is a slight improvement year over year. The inventory remains tight, though, particularly when we compare it to the peaks of pre-pandemic years like 2017 through 2019. This is certainly something we'll keep an eye on as we move into the winter months. So where does this leave our renovators, our fix and flippers? Well, one of the emerging trends from this supply-constrained market is a growing focus on the renovation of existing housing stock. We're seeing a clear uptick in loan applications at Groundfloor, especially for these types of renovation projects. And this makes perfect sense given the aging state of the U.S. homes. Did you know that 80% of U.S. homes are now over 20 years old, and more than 40% are over 50 years old? At Groundfloor, we're positioned perfectly to support those projects. Banks don't typically lend on these, and we handle them every day, whether it's fixing up an aging home or completely overhauling a property. We're particularly excited about the long-term opportunities that these renovation projects bring for our investors, especially as project costs are expected to lower alongside falling interest rates. If we shift gears and talk about builder sentiment and new construction projects. While builder sentiment peaked in March, we've seen a recent decline. However, the September Fed rate cut, there it is again, has injected some renewed optimism in this market. The National Association of Home Builders Wells Fargo Housing Market Index, actually rose to 41 in September, up from 39 in August. And what does that mean? Well, that index is from 1 to 100. It's an index measuring sentiment, and 50 is the middle. Above 50, a score above 50 represents builder bullishness, and a score below 50 represents builder bearishness. So in September, the score went up to 41 from 39 in August. So you can see 2 points up in the direction of becoming more bullish. Builders are reporting improved sales conditions and a brighter outlook for the months ahead, with fewer builders cutting prices. Important to note. At Groundfloor, we've been a consistent partner for small builders through all market conditions, offering flexible, non-bank lending solutions for new construction projects. Our track record in this space continues to grow and is excellent, and we're excited about the opportunities that lay ahead for our borrowers and investors as it relates to new construction loans. Speaking of this opportunity, I did want to take a minute to go over the numbers, the results of Groundfloor's new construction loans, because the performance has been outstanding. To date, we have had repaid loan volume of $156.7 million. The net rate of return is 9.9%, and the delinquency rate is just 2.96%. What does delinquency rate mean? Well, delinquency rate is a percentage of loans that did not lose money, but did not settle at contract interest rate. So it was somewhere in between a loss and contract interest rate. That's delinquency rate. So 2.96% of the total number of units originated had a delinquency. And finally, the loss ratio, which is what we peg a lot to at Groundfloor, for repaid new construction loans is 0.09%. So less than 10 basis points. Again, total repaid origination loan volume, $156,700,000. The net rate of return, 9.9%, with a delinquency rate of just 2.9%. With a loss ratio, the number that we peg at Groundfloor, that's loss of principal of just 0.09%. If you'd like to read more about new construction's loan performance and a comparative analysis alongside other types of Groundfloor loans, please visit groundfloor.us, click Learn, and then select Blog, and you can find my September Market Trends blog out Monday, October 7th, and you can really geek out on the numbers. And what would be a good way to ensure you get the most out of loans like our new construction loan offering? It's by utilizing our newly released Flywheel portfolio, the UNREIT. The Flywheel portfolio is designed to give you automatic diversification across both new construction, heavy rehab, fix and flip, cash out refinances without the hassle of selecting individual loans and parsing out all those details. The Flywheel balances risk and return by spreading your investment across 200 to 400 loans at once, giving you access to both project types, all project types in one portfolio. This takes the guesswork out of managing an LRO portfolio and allows investors to focus on the bigger picture, building a stable, long-term portfolio with consistent returns. That is the Groundfloor motto: stable, long-term portfolio with consistent returns. It's the perfect solution for investors because they can balance risk and return, and I highly recommend you checking it out if you haven't already. We've had amazing early returns on this recent release product, and it was a very careful, deliberate, well-researched product release. And that is our today's episode of Groundfloor Market Trends podcast. And thank you for tuning in. We'll continue to keep you updated on the latest housing market trends, our loan performance, and exciting new opportunities here at Groundfloor. And until next time, keep investing smartly, and remember, Whether it's new construction or renovation projects, Groundfloor is here to help you grow your wealth with confidence.